Hello everyone, welcome back again to talk about fundamental analysis. This is Amr Al-Alfi, and today we'll continue to talk about the definition of fundamental analysis and what went on over history to really try to understand what fundamental analysis is all about. Maybe the importance of fundamental analysis has surfaced very recently over the past few years. Maybe the past few years with all the investors around the world have seen couple of crises that we all witnessed, and we all of course remember the major financial crisis that we've witnessed recently, and this is basically the global financial crisis. It is abbreviated also as GFC. Obviously this was back in 2008. However, crises continue to happen every now and then, and history repeats itself. But if we go back in history, say 10 years back, and specifically 1998, there was also another crisis. But investors did not really feel that crisis much, because the impact of the crisis actually been contained by the regulators. And this crisis came to be known as the long-term capital management, or Ltcm. The story of Ltcm, in brief, it is basically a hedge fund that was investing its funds in different investments. We would say that alternative investments, and this Ltcm was investing in different types of derivatives as one of the different asset classes. But the problem with Ltcm management is that they were very confident in their methodology. They were very confident in the way they do business, and this is where the problem came. Their methodology was basically that they found out or they kind of discovered a certain system or an equation or a couple of equations, so to speak, to tell them exactly what to invest in based on history, looking in history, all the historical data, and they start investing and trying to predict what's going on in the different asset classes that they invest in. As you can see the chart, the peak was basically 1997, beginning of 1998, but this was the peak. See that the return of Ltcm outpaced the return of Dow Jones, then it fell off the cliff. So turns out that if you invested $1,000 in Dow Jones Industrial Average, or if you've invested in US Treasuries, you had made much better return than Ltcm. And this is all despite the fact that two board members of Ltcm were Nobel laureates, and these are the two who actually created or invented the option pricing model. The two scientists or mathematicians who've actually founded the Black-Scholes model. And as we could see from the chart, the drop or the collapse that we've seen came about basically because the manager of this fund was thinking, or they were expecting, that they would be making money when certain things or certain factors take place. However, the things went the other way around, and they had to liquidate their positions, and hence the huge losses that we see on the chart here. However, we did not really feel the impact of this crisis because simply the US government intervened to ensure the proper liquidation of the investments owned by long-term capital management, to make sure that there is no huge sell-off or forced selling, which would have actually reduced the value of investments and would have negatively affected investments all over the place. Also in 1997 we had another prior crisis, which was the Asia crisis, and also around that same time we had another crisis at Russia with the debt moratorium. And so basically in the last couple of decades, we see that history repeats itself, and we continue to see crises all over the place, and this is gonna continue in the future. This ends our episode, and I'll talk about more fundamental analysis in the future. Thank you very much.